Today's Talk About It Tuesday question is, as an older investor, I'd like my portfolio to provide more income than growth. My index fund is great for growth but pays very little in dividends. How can I get similar benefits of diversification and consistent positive returns, but also get more income in dividends than an index fund? All right, this is a great question. One thing that we have to understand is that as we age and as our circumstances change, our needs from our portfolio will change also. So, an index fund is a phenomenal investment for growth, meaning that year over year its value increases, but it does pay very little in dividends because many of the stocks that drive its growth that are in the S&P 500 are what we call growth stocks, and they don't pay dividends. There are some solid companies in there that do, but overall is driven by the growth stocks. Those usually lead the S&P 500. And that is phenomenal when you are young, right? You want this growth, but the only way to get the money out is to be able to sell some of what you own. And that's not necessarily what you want to do as you get older. So your portfolio has to shift towards something that provides some income to offset whatever retirement income that you have coming in, or to supplement, I should say, whatever retirement income you have coming in. So I'm going to give you three different ways in terms of a portfolio that you can generate income that are well diversified and get you a consistent return. Now, of the three, I think one far outpaces the other two. So I'm going to start with the one that I think is probably going to be the least attractive and give you the least return, but will at least hedge against inflation, meaning it might meet the inflation rate so your money won't lose, but you're really not going to gain. And that is a bond ETF or a bond fund. So what's the difference between an ETF and a fund? A bond fund is a mutual fund that invests in different types of bonds. A bond ETF, an ETF is an exchange traded fund, is still a bucket of ownership, just like a mutual fund, except it can trade every hour on the hour. We're not concerned with that part of it. We're just concerned with what's in it and its performance. So in general, you're probably not going to get more than 3 or 4% return annually, but you get interest income from it. So that's, again, probably the least attractive, and it could be something to round out your portfolio, but won't be the bulk of your portfolio in terms of the aspect that brings you income. The next thing I would do is probably a REIT, a real estate investment trust, or a real estate based index fund, or a real estate based ETF. Those will pay you pretty well depending on the one that you choose. And the reason I like them, REIT ETFs or REIT funds, is a REIT has to pay out 90% of its profit. So a REIT is a real estate investment trust is a bucket of ownership of real estate in a fund, but then you have a REIT index fund or a REIT ETF is a bucket of buckets. So in essence, you could own a piece of 200, 300, 400 properties that pay income. And again, a REIT has to pay 90% of its income to its shareholders. And with the ETF, again, you have the diversification and you have a lot of ownership. And so you're getting income constantly. I believe REITs, ETFs, instead of paying quarterly, might pay monthly, which is an advantage over some of the other dividends, which are paid quarterly. So I would definitely have that as a piece of my portfolio, but again, not the bulk of the portfolio. So the smallest part of my income portfolio would probably be in a bond fund type of thing, and then a real estate type fund. But the biggest part would be a dividend or a couple of types of dividend funds. So I would have a U.S. broad-based dividend ETF um, that has probably 300 companies that have a consistent payment and increase of dividends annually. There are a few out there. You can research those, which are good. I would probably have, as a smaller piece of that, an international dividend ETF that deals with companies from around the world that pay usually a little bit higher. And I might even round that out with one that's high return dividend ETF, even though those are much more volatile and probably won't be as strong as your U.S. broad base. So to round it out, to just sum it up, the top would be a U.S. broad-based dividend ETF. I would supplement that or support that slightly with a small amount and an international dividend ETF, and maybe a high yield, dividend ETF. Then I would do probably a real estate based ETF, and then the smallest amount, very smallest amount, my defensive position, my security position, tiny amount that pays income would be a bond-based ETF. So that would be it. And again, as we get older, we want to start generating some income from our portfolio without having to sell anything in it, right? Because once you sell it, it's gone. So when you get a little older or close to retirement or you're in retirement, you might have to start shifting your investment over to income and less growth. So that's my advice. I think that's a good strategy for people who want income over growth, or in a position who need income over growth. People who are a little bit older, people who are close to retirement, people who are in retirement, people who just want to supplement their current income. I think that's a good strategy for people who want to do that. So I'd like to hear your thoughts about it, but please like, share, subscribe, keep the questions coming, and I'll see you next Tuesday.